Welcome to the Whatcom County Business Alliance virtual, for the first time, virtual economic forecast. The Whatcom Business Alliance is a membership organization comprised of companies and individuals across the community that facilitates business success and community prosperity. They promote a positive economic climate for Whatcom County and related businesses. Please visit their website at whatcombusinessalliance.com for all their events and other information, including membership information, and consider joining today. Also, for those of you who have not joined an event like this before, as we proceed forth with the presentations, just a reminder, obviously this is virtual, so if you have to dash in and out, we understand that. And the complete video presentation will be available on the website at whatcombusinessalliance.com within a couple of days after the end of this presentation. So I want to thank all of our participants for coming today, and of course the key sponsor, which is Wells Fargo, for sponsoring this annual event. I'd also like to thank our co-sponsors and Western Refinery Services, Puget Sound Energy, and more. We have an exciting program today before us. We have, I'd like to also thank WRS, Quality with Integrity, for co-sponsoring the event, and VSH, Certified Public Accountants. We have an exciting program today. We're going to talk about the economic outlook for the country, for the state, some trends that might impact your business or industry, and we're going to go into some considerable detail on these things. However, if at any point you have a question, this is an interactive event. We'd encourage you, at the bottom of your screen, you'll see a Q&A box. We'd encourage you to enter that question into the Q&A box so that we can, during the Q&A, go immediately to questions. The plan is for the event to end at 9 o'clock sharp. However, we are available to go over if there are additional questions, so I don't want you to feel like you can't get your questions answered. Plus, if we do run out of time, we'll try and get your question answered later on via email. So at any point, just enter your question into the Q&A, and we will be getting to that toward the end of the program. We are going to start the program with Tim Quinlan. Tim is a director and senior economist with Wells Fargo, the sponsor of this event. He's the senior economist with Wells Fargo Securities and provides analysis on the U.S. economy and major foreign economies. His work has been published in academic economic journals. His comments on the economy regularly appear in the Wall Street Journal, the New York Times, USA Today. He's also a frequent guest on Bloomberg TV, CNBC, and National Public Radio. Tim Quinlan, welcome.
David, thank you very much. And thanks all of you for tuning in to this today. I've had the pleasure to be there with you a few times in person, and I'm very eager to get started here. We've got a lot to cover and not a ton of time to do it. So I'll get kicked off with kind of a brief overview of kind of where we see things going in terms of the overall economy. And of course, the reason that we're doing these things remotely to begin with is the fact that we're in the midst of this pandemic. And in that regard, things are actually, this is a pleasant thing to be able to say, they're moving in the right direction. So your daily case counts are down almost 60% from their peak. So we were adding, almost 250,000 new cases a day at the start of January. And you can see from the chart there, the blue line on the left-hand side, we've got that well under 100,000 now, and the positivity rate is dropped below 5% nationally. And while these figures kind of move around a little bit, depending on where you are in the country, you can kind of see that Washington, by and large, is a little bit of an uptick at the very end there, but for the most part, doing better than a lot of the broader figures across the rest of the country. And that comes after, of course, after kind of an earlier surge where Washington kind of was one of the spots that the country had its eye on at the outset of this thing. And you see this reflected in labor market dynamics, and that's true nationally, and it is true in the state as well. So you can just see the overall trends on the left-hand side there, and then you can see the varying difference between the participation rate in the labor force. And I think that the quick observation here is that Washington is doing a little bit better than the country as a whole in both of these measures. And when you look at the the composition of this by industry, and you think about, okay, well, what categories are doing well, and which ones are, obviously a lot of industries are down in terms of employment, which are hurt the most. And I think it's important to point out leisure and hospitality. You probably had a sense of this coming into the event today, but leisure and hospitality really leads those declines. And as a share of overall employment in Washington, that's a little bit of a less important industry than it is in some states. So, if you think, for example, of places like Florida or Hawaii or even Nevada, you see leisure and hospitality comprising a much larger share, and those markets are seeing a bigger hit to the jobs markets there. When you look at weekly jobless claims figures, so that kind of moved in the right direction this morning, meaning we had fewer people filing first-time claims for unemployment insurance. But you kind of look at this relative to where we were before the pandemic, and I think it's reasonable to say that it's probably still a little higher than what we'd like to see. But by and large, the fact that we've got this the virus itself kind of on the run, and the fact that we've got a lot of new fiscal policy expected around the corner, and we can debate the wisdom of that policy separately, but the fact that it is likely coming, that to us means we're going to see a pretty robust rebound here in the next few quarters. So we just got some modest revisions to fourth quarter GDP data this morning, but it is increasingly looking like the first quarter of this year is off to a rather compelling start. January retail sales figures last week were a little stronger than expected, and durable goods figures this morning were posted a month-over-month increase in January that was more than 3 times larger than what the consensus was looking for. And that was true with core capital goods shipments as well. That's kind of a key indicator for where business equipment spending is going. So you see kind of a pretty strong surge here coming next year. And that, in terms of the shape of the economy, finishes out the right-hand side of that letter V that we've talked about, kind of a V-shaped recovery. And I think it's reasonable to say that at the far end of this, we're dealing with an economy that's more or less back to its kind of pre-COVID trajectory. So we're kind of closing that output gap. And a lot of this has to do with the composition of consumer spending, which you see in this chart. And the blue shaded categories here are all of those categories that are services related. Sometimes you hear that the consumer is 70% of the economy, and it gives you this impression that our economy is just based on people going to Walmart and the grocery store and buying stuff online. And those things matter, but only to a small degree. The much larger share of spending is in the services sector. And what we've experienced in this downturn is unlike what we typically would expect to see. So in the chart on the left-hand side here, we look at the various categories of consumer spending. So you've got your overall services, and then you can kind of break the goods categories into durable and non-durable goods. And what you usually see, and this is, I'll kind of try to point to this with the cursor here, is this red line is durables, and that really typically craters for the first year or so of a recession. People think they're going to lose their job, or that the bottom's going to fall out under the stock market. That's no time to go buy a new car or new appliances around the house, or a jet ski or something like that. That's the time when you see a lot of sharp retrenchment there. And then later in the cycle, when things get better and you've repaired the washing machine for the 3rd time, it's finally time to go start replacing that stuff. And so this ramp up that you typically see later, I think I forgot to say at the beginning, these lines represent the average of the past 6 downturns. And so then this kind of ramps back up, and that tells you you've got this pent up demand kind of showing up on the durable side. And I'm getting ready to show you some pretty aggressive numbers in terms of our forecast for consumer spending. And it's largely predicated on this dynamic. Usually services spending, again, this is about 2/3 of all consumer spending, that's usually the heavy keel that keeps things steady throughout a crisis. Now, if you look at this chart on the right-hand side, this is what we've actually experienced during this downturn. And what you find here is that services spending is still 8% below its pre-pandemic peak. And so my point here is basically you've got pent-up demand in the really large category of spending. So as the economy reopens, and as we've got all of this extra cash to spend to finance our activity in the service sector, I think that there's scope for that to come back with really strong momentum. Well, let's look at what some of the high frequency data are telling us. So the chart on the right-hand side is retail sales. The one on the left is the personal income and spending report. And we'll get fresh January figures for personal income and spending tomorrow. And what you kind of see here is these categories are ranked by the largest categories to the smallest. And most of the ones that are in negative territory, that are down from their pre-pandemic level, have a services component to them, whether you're talking about other services or healthcare or recreational services, transportation services. These are the categories that are sharply lower. The point I'm making in the chart on the right-hand side is that we've had this kind of switch to spending more money on food at home versus going out to eat. That's a kind of a reversal of a trend switch over the preceding 20 years. And another trend that you can see over the last 20 years is the gradual ascent of e-commerce, put as non-store retailers here. And you can really see how that has jumped into the future as in the midst of this pandemic. And you might think to yourself, well, what is driving all of this spending in the goods sector? I mean, how is it possible that this category is 10% above its peak at a time of high unemployment? And we keep hearing about these businesses that are closing. How is spending so strong? And I think if you just look at employee compensation, the red line in this chart, we're only now back to our pre-pandemic peak in terms of employee compensation. But if you add in the stimulus checks and the additional unemployment benefits, well, now you're talking about a really significant surge in consumer incomes. And the results of that has been pretty obvious. First of all, at the height of the lockdowns, we couldn't spend much at all. So the saving rate shot up to 34% for a while. But you can see it's come sharply lower. But even at its current level of 13.7%, that's still larger than it's been at any point since the 1970s or so. So households are really saving quite a bit here. And the benefit of having been saving since around March of last year means that we've accrued a pretty substantial hoard of built up cash, at least in aggregate. So the chart on the right-hand side here, there's kind of two shades of red. The lighter red is kind of your pre-COVID saving rate, and then the darker red bars indicate the additional savings that we've accrued, what I call this kind of forced thrift, because the fact that you're not able to send the kids to camp or go on vacation or go out to eat as much, these are the sorts of things that are contributing to this higher level of savings. And if you add up those red bars, that's what gives you this kind of blue line here, which I call the cumulative excess savings, which at this point adds up to about $1.5 trillion. And that's what underpins this forecast. And let me kind of explain what you're looking at here. This sharp down and sharp up, this is the lockdown and then the reopening. So I think you kind of take both of those with a grain of salt. What's actually a bigger deal here, and it visually may not look that impressive, but these two quarters, in the second and third quarter here, we've got double-digit consumer spending growth for 2 quarters in a row. In data that go all the way back to the 1940s, this has never happened before. And it's always a dangerous thing to say this time is different. And I'm leery of it myself, but this is my line in the forecast and I'll own it. I think that people are underestimating the capacity for consumer spending to snap back later this year. And if realized, this would result in a 6-month surge in spending, the likes of which we've never seen, literally. That's why Wells Fargo's forecast is in this unfamiliar territory of being at the very top end of the consensus forecast right now. In prior years, when I've been with you, we've been, a little bit more pessimistic. We've been below consensus. That, with the benefit of retrospect, has for the most part been the right side to be on. But in our view, this is an appropriate time to start getting geared up a little bit. This is true in the manufacturing sector as well. You can see industrial production growth has snapped back. Our forecast is for manufacturing activity to continue to come back online. This also gets a little bit of a wind in its sails in the wake of this morning's durable goods report. Equipment spending has been strong as well. This was this was in sharp retreat even before the pandemic came along. If you look at the quarterly figures here, we had 5 consecutive quarterly declines. Some people were calling it a manufacturing recession before the pandemic even came along. This is, at the time, worries about late cycle dynamics in 2019, worries about the trade war that was going on at the time. So kind of the reset that the pandemic gives us has already given way to pretty strong spend here in the last couple of quarters, and what we expect to be pretty steady continuing going forward. Housing is looking good. New and existing homes are both selling at about as fast a clip as they have since the height of the housing bubble. That's, of course, underpinned by the pandemic itself, but also the fact that mortgage rates are as low as they are. We talked about unemployment figures locally. Here's kind of what they look like nationally. Not as much improvement as you see in a lot of the other areas. So whereas I talk about consumer spending and the manufacturing sector getting back relatively quickly, we actually do not have the jobs market rebounding that fast. So here you see the unemployment rate, and even at the end of 2022, that's not yet back to its pre-pandemic peak. And this is what I think has helped foster some of these programs that you're seeing in the government level. The lines here represent the difference between the financial crisis in blue and the COVID crisis in red. And the point is to say that even now, after several months of recovery, we're more than 9 million jobs shy of our pre-pandemic peak. That's a bigger disruption than we experienced during the height of the prior cycle. And a lot of the layoffs have shifted from being temporary layoffs to being permanent ones. We already have the December COVID relief bill. I won't read through all the lines of it here, but about $600 billion of that is kind of geared toward households in one form or another, either through direct relief checks, extension of unemployment benefits, or increases in the amount of those weekly unemployment benefits. And if you kind of place this most recent round in the context of all the other COVID relief that we've had, it would kind of represent this line here, $868 billion. So add that all up, and it's $3.3 trillion, or 15% of the federal fiscal budget deficit. And now we're talking about adding another 1.9 trillion on, which alone would be another 8.9% of GDP. And you think of this in the context of the budget deficit, that means we'd be running the biggest budget deficits we have since the height of the Second World War. And that, of course, raises some worries and doubts about inflation. Inflation is kind of creeping higher. In the quick version of this, I'll simply say we expect inflation to kind of overshoot here in the short run, but eventually not to exceed its 2% target that the Fed has kind of established for it. So I think the program now is to kind of continue and go on to the other speakers, and then I will be back at the end to answer any questions that come up. So with that, David, I'll send it back to you.
Thank you, Tim. Really fascinating. And thanks again to Wells Fargo, the primary sponsor of today's economic forum. Next up, it's always interesting to introduce a friend, because you think, as coworkers at Washington Policy Center, you think of these individuals outside of their professional resume. But Dan Mead-Smith has literally been the face of Washington Policy Center for 20 years. He became president in 2001. He's testified by invitation countless times before legislative committees in Olympia and appeared on numerous radio and television programs around the state. He's also appeared on PBS's Debates television program, is a member of Seattle Rotary Number 4, a board member of the Greater Seattle Chamber of Commerce, and a founding board member of the Workers' Rights Alliance and the U.S. Global Leadership Coalition's Washington Advisory Committee. Welcome, Dan.
All right, thank you, Dave. Great to have you moderating. Great to be back at the Wacom Business Alliance. I've done this event, I think, 4 years in a row. It's good to be back, even though it's virtual, but miss being with everybody up in Bellingham. Dave didn't mention that half of our 4 panelists are Western Washington University alum. So proud to be a Western alum, and wish I was back in Bellingham today for that reason as well. I'm gonna build on what Tim covered, but dive in a little bit more on just focusing on Washington State and then also Whatcom County numbers. I'm gonna look at state employment, look at some of the export numbers for Washington State, give a quick outlook, and then go into some Whatcom County information. There's a brand new study that just came out from the Milken Institute that talks about Whatcom County. and then look at some of the great information from Western's Border Institute and their border closure impact information. And then turn over to my other colleague, Paul Guppy, who will talk about some of the policy impacts that are impacting the economic outlook in our state. So let's start with Washington State employment numbers, a little bit what Tim covered, but a little bit different information. Unemployment, 7.1% in December. That's the most recent data we have. So about 7%. The last time outside of, of 2020, it was this high was in June of 2013. So about 7.5 years ago was the last time the unemployment rate was this high. The unemployment rate about a year ago, so to compare where we were pre-pandemic to today, 4.3% versus 7.1. Number of workers receiving layoff notices is the highest since 2009. The 2008 kind of financial recession, this is the highest, not surprisingly. Total non-farm employment has decreased 6% over the last 12 months or so. And the GDP growth forecast is definitely looking up. That's part of the good news that Tim was sharing, hopefully, over the next few months. It was negative for 2020 and predicting an increase of about 3.8% for 2021. I don't like sharing all this bad news, but that's what they asked me to do, is share the actual facts of what's going on. And a lot of this is not a surprise for a lot of you, but I'll just share a few more data points. Again, between December 2019 and December 2020, 189,000 net jobs were lost in Washington State. Not surprisingly, the largest were in manufacturing and leisure and hospitality. Professional and technical services actually saw an increase. Seasonally adjusted private sector jobs lost 10,600, and public sector actually gained 700 jobs in December 2020. So that's interesting that government side continues to grow even during this pandemic, but private sector, not surprisingly, lost 10,600 jobs just in December. The unemployment rate increased from 3.1 to in 2019, and we're ranked 36th in unemployment change for Washington State. South Dakota is the best, and our neighbors, you can see, Idaho is 19th, Oregon is 34th. So we're very similar to Oregon with ranking 36th. Here's this is from the state of Washington. This is the unemployment rate projections. So you can see it was an average of 8.3 over the entire 2020. Their projection is 6.5 for this year, and then the news does get better for sure. 5.1, 4.6, as you can see over the next few years. This was as of November 2020, the state's unemployment projections. And then here's shows you on a chart form the non-farm payroll employment. You can see, of course, the big dip last year, but again, the numbers are looking better over the next 3 years. It's going to take a while, at least till 2022 or so, to get back to where we were at the end of 2019. But the forecast does show a continuing increase in employment over the next 4 years or so. And then income and inflation. Washington personal income rose from 500 billion or so in Q1 of 2020 to 544 billion in Q2 before dropping to 534 billion in Q3. That's the most recent numbers. And again, it's good to compare it, I think, to other states. So our negative 7.3% was actually the 9th best among all the states. So every state had a negative personal income. Georgia, just barely negative. That was the best. West Virginia was the worst. Washington State, again, actually was pretty good, finishing 9th and much better than our neighboring states of Idaho and Oregon, as you can see. And then here's personal income in 2020 again, and you can see the projection by the state over the next 4 years or so. Definitely is looking good over the next 4 years. It's going to go up, slowly, but it's going to go up over the next few years, including this year of 2021 for personal income. And then the exports, I know, Washington State is one of the most trade-dependent states in the country, and Whatcom County also is very trade-dependent, and not good news as you can predict, and as a lot of you are experiencing as business owners. But here's the actual numbers of a decrease for 7 consecutive quarters, even going back before the COVID pandemic. And still showing a negative looking ahead a little bit for this year. So here's kind of a summary of the recession indicators. Number of workers in our state receiving layoff notices in 2020 was the highest again since 2009. There's a heightened risk of downturn in construction. Construction actually was doing pretty well in our state during the pandemic in 2020, but there is a risk of downturn as we look ahead to the rest of this year. Year over year, exports decreased 43% in the second quarter of 2020. Of course, there's threats to the economic expansion, including concerns about international trade, fiscal policy, and maturing expansion. The estimate is that we will not be back to pre-economic activity until the fourth quarter of 2021. A lot of the areas have been talked about: business travel, office space demand, retail and small businesses returning, and even if they can survive, hopefully till the fourth quarter. One bright spot that has remained strong, though, is residential real estate, especially in Washington State and the Puget Sound area, including in Whatcom County. Here's some Whatcom County numbers. So the unemployment rate is almost the same as the state. I mentioned 7.1% for the state. Whatcom County just a little bit higher at 7.2%. Unemployment rate in December 2019, before the pandemic, was 4.7%. So we've increased from 4.7 to 7.2 for Whatcom County. Since 1990, the unemployment rate of Bellingham has peaked at 11.1% in February of 2010. So about 11 years ago, we saw 11% unemployment. So 7.2 is better, but still much higher than it was about 12 months ago. Whatcom County has about 100,000 non-farm jobs, just as FYI. And Whatcom County lost 13,000 jobs from February to April of last year, of which about 9,000 were recovered by September of last year. Bellingham is in the top 20 of the metro areas forecasting the highest percentage of job losses. And if current restrictions remain, this was from last fall, job losses could be around 6,000. This is just kind of FYI. I won't spend a lot of time on this, but this is some of the largest contributors to GDP in Whatcom County. As a lot of you know, what the average wage was. A lot of these numbers are old. They're the most recent, 2018, but they're not really relevant. But it's just good to, as FYI, to see kind of what the average wage and or personal income in Whatcom County was. And then this is that study I mentioned earlier that the Milken Institute just put out, really interesting. Bellingham, this is 2020 data. This is their 2021 study, so it includes 2020 data. Milken Institute identified the top performing US cities, and Bellingham metro area, which is Whatcom County, continues to stay on the list of their top performing of small cities. They were ranked, Bellingham was ranked 10th in their 2020 report, so for 2019, and 12th, so pretty much the same. Where you didn't rank very well was in housing affordability. The report warned that the housing affordability issue, if not addressed, housing growth is not keeping up with the wage growth in Whatcom County, and it could have even a bigger negative impact on the local economy. And this doesn't take into account the Alcoa news of the 700 jobs lost at Alcoa, at the Alcoa facility. So this does not take into that account either. The median home price for Whatcom County rose 10.5% in a year to $442,000. Bellingham median price for a home was $523,000. And then finally, I'll conclude with some information that the Whatcom Business Alliance asked me to address about the Canadian border. Again, a lot of this has been addressed in your local news, and this is from Western's Border Policy Research Institute. And the numbers aren't through all of 2020, they're just through the first couple quarters. But you can see here about how, as all of you guys know, how important the Canadians coming down to Whatcom County is when it comes to retail sales, restaurants, gas. Pretty amazing how much of the Canadians comprise 73% of Blaine's fuel tax revenue. That's pretty amazing. But you can see here for the first 2 quarters of last year, retail sales in Whatcom County fell by somewhere between 54 and 65 million in quarter 1 and quarter 2. That's the most recent data from the Border Policy Research Institute. Due to the COVID policy border restrictions, you can see kind of the other numbers here. And then finally, yeah, obviously the daily border crossings remain at 98% below typical levels. The restrictions also limit the number of tourists, and then the airport is impacted. 70% of Bellingham Airport passengers are typically Canadian, and that explains the number of passengers were down by 70% in September of last year. So with that, I'm going to turn it, I'll have go back to Dave, but we'll talk now about some of the policy implications that we're seeing as we look ahead to the forecast for Washington State and Whatcom County. Thanks again for having me.
Thanks, Dan. And it's been mentioned, some people are interested in getting the slides. So if the speakers are amenable, we'll make sure that you can get a copy of these slides, assuming that presentation is all right. And so we'll ask them about that, but we're going to try and make those available. I want to take this opportunity to again thank the primary sponsor, Wells Fargo, for sponsoring this event from Whatcom Business Alliance, the Economic Forum. As you've heard, we're getting some great information here. I also want to thank the co-sponsors, Western Refinery Services, Puget Sound Energy, VSH Certified Public Accountants, because of course they make events like this possible. Don't forget also to check the Whatcom Business Alliance, whatcombusinessalliance.com, their website for membership information, as well as information about future events and upcoming events. Right now, it's my pleasure to introduce Paul Guppy. He's the Vice President of Research at Washington Policy Center. He's a graduate of Seattle University and holds graduate degrees from Claremont Graduate University and the London School of Economics. He worked for 12 years in the U.S. Congress as a Chief of Staff and Legislative Director. And as the Vice President for Research, he writes extensively on tax policy, public finance, and other issues, and is a frequent commentator on TV and radio programs and in newspapers across the state. Paul, welcome.
Thanks for the introduction, Dave, and thanks to Barbara and the Whatcom Business Alliance for hosting this event. As Dan mentioned, we've spoken at this event in the past, and as we were doing our organizing meeting yesterday, I just mentioned that I'm looking forward to having this event being done live because of the energy of the people who attend, both before the event, during, after. It's just a great networking event and a lot of fun. So this year we're doing it online, which is fine, but we look forward to getting back to a live event in the future. So what I'll do, we've had 2 good presentations about what's going on with the economy. And what I'll do is talk about the wonderful political and policy world that's going on in Olympia. Our research staff is following bills and issues and testifying before legislative committees as invited by the lawmakers themselves. And I'll just take about 10 minutes here and give a quick overview of the main things that are happening in Olympia and how they will affect the rest of us when the session is over. So first, a quick political summary. So Democrats have Washington is a trifecta state, which is to say one party controls the House and the Senate and the governorship. And in our state, that's the Democrat Party. In the House, they have a majority of 57 to 41. And in the Senate, it's 28. The Democrats have a majority of 28 to 21. And we have a bit of a quirk in our state because one Democratic senator often votes with the Republicans. But Democrats have control in both houses. They are setting the agenda. We are following the deadline dates as to when bills have to reach a certain point in order to be passed. We passed the first cutoff date, which was bills being passed out of committee. That reduced the number of bills being considered from about 2,500 down to about 400. And the next cutoff date is on March 9th, and that is when a bill has to be enacted in its house of origin, the House or the Senate, in order for it to continue for the rest of the session. The only caveat there is that any bills related to the budget can always be brought up at any time. And then, as I always point out to people, these are interior artificial rules that the legislature has for themselves. So they can alter those at any time. Technically, any bill can be brought up at the very end of the session and then put into the budget and passed that way. And then lastly, the executive branch, as we know, is again controlled by the Democrats. Governor Inslee was just elected to his third term. He is the second governor in the history of our state to serve 3 terms. And the Democrats have controlled the governorship in our state for 34 years, which again is a record. That's more than any other state. So that's the setup in Olympia. Regarding issues, I'm going to touch on key issues that have been debated, but don't look like they're going to go all the way to the end of the session. Then touch on the budget briefly for an overview, and then talk about what we see coming that will be enacted. So first of all, there was a debate all through last year about whether the legislature would hold a special session. What are the emergency powers of the governor? As we know, no special session was called in August and September of last year, as was expected. And so the state has been operating, like a lot of states across the country, entirely under executive order. A study was done of all 50 states that shows that we are among the 10 strictest, some people would say worst or best, depending on how you look at it. But the measurement shows that Washington is one of the 10 strictest when it comes to emergency rules. So what that means is that the governor in our state, under the law, he decides when a public emergency begins, he decides when it ends, and he also has complete control over all laws that are in effect. He can suspend or cancel any law for the duration of the emergency. And that's the system we've been operating under now. A number of lawmakers of both parties are concerned about that. There have been bills introduced to, like other states have, to put limits on the governor's emergency powers. The main one that in our state was HB 1029. Jason Mercier, budget and government expert on our staff, testified in favor of that bill, but it doesn't look like it's going to move forward. So that is an issue that was debated, and it appears the result will be the status quo. What 1029 would have done would have said the governor's powers in the future can last for 30 days, and then the legislature has to meet and reauthorize it for another 30 days. But in policy terms, that's not going to change. So we're going to end up with the same emergency powers that we've had. Quickly touching on other major issues that have been debated in the legislature, but again, do not look like they're going to be resolved, is a major bill to reopen the schools. There was a big push to reopen the economy further. A bill was proposed to cut the B&O tax permanently to help the business environment in our state. There was a bill to give $3,000 scholarships to families that are attending schools that have been closed, so that money could be used to pay for education services. And the reason I'm touching on those quickly is because they were major initiatives, but it looks like with the cutoff dates, those issues are not going to be enacted. So again, the result in the policy realm is that status quo on those issues. Next is a quick overview of our budget. So Washington State has a 2-year budget cycle. We are in a longer legislative session this year, halfway through a 105-day session. The major job for lawmakers is to enact a new 2-year budget for 21-23. The state's fiscal year starts on July 1st, so enacting the new budget during the spring, and then it goes to effect in July. The current 2-year budget that we're in is a total of $54 billion in spending for the state. That's a record. As was shown in the slides earlier, we had a tremendous economy up until February of 2020, and that was bringing a lot of revenue in for the state. We've been affected by the COVID health crisis like as everyone else is, but unusually, Washington State is one of 6 states that actually did not go negative in its revenues. We are still on the positive side slightly, even through all of the disruption that we have experienced. And so lawmakers are anticipating that they will get a 7% increase in revenue as they write the next 2-year budget. And that puts us in great shape regarding state spending. Even so, the governor has proposed a budget in the next cycle of $58 billion, which is slight, so maybe he calculated it this way. It's slightly beyond the 7%, it's about 8.5%. And so because of that, the governor has proposed a number of new taxes and revenue bills that I'll review here in a second. And then the last point about the budget regarding longer trends, and Washington Policy Center has been following this every year for a number of years, is total state spending is up by more than 77% in 10 years. So we've seen, since the last recession, a major expansion in the overall size of state government programs. And that's where that $54 billion budget comes from that we have now. So moving on to what we see happening next is major revenue proposals have been made or being debated right now in the legislature. The biggest one, which popped up as kind of a surprise, is SB 5096. This would create a capital gains income tax in our state. As any of you who are involved with Washington Policy Center know, we have worked on state income tax issues for years, consistently arguing that it's not only unpopular, voters have voted down a state income tax 10 times in the past, but it's also not good policy for our state. So we are one of 9 states without a state income tax. It's a positive condition for bringing investment. It's a major reason why the tech industry has grown so much in our state, and it helps other sectors as well. The governor in his budget earlier in the year proposed a capital gains income tax, but that's just the governor. It takes the legislature to enact it. So we were tracking bills to do that, and everything looked routine until a couple of weekends ago. The Ways and Means Committee in the Senate suddenly brought up the capital gains income tax bill and passed it, which had that procedure had not happened in sessions in the past. So that's a new condition. The tax would be imposed 7% on the sale of investments above $250,000. So it's set at a very high level right now. What our concern is that the moment we have any form of income tax, that structure will be used to expand to other types of income, and then primarily lowering the income threshold until it begins to hit the average business owner, the average working family. And in fact, it could get to the point where it affects just everybody in the state. And like California and most other states, Washingtonians would end up filing for a state income tax in addition to their federal taxes. So we see that system coming. The other element regarding that bill, SB 5096, again, an interesting maneuver, not necessarily a surprise, but lawmakers attached an emergency clause at the end of the bill. And what that means, even though the tax, if enacted, wouldn't go into effect until 2022, the so-called emergency, as far as we can tell, is that technically that means that this law could not be recalled by voters. So normally in our state, you can have a popular referendum. If the legislature passes a law that the voters don't like, a petition can be circulated, collect signatures, get put on the November ballot, and then the bill, that law would be repealed. The emergency clause makes that whole procedure impossible. So if SB 5096 ends up being enacted, there would be no opportunity for a popular movement to repeal that bill later on in the fall. So that, and what I'll close with is a number of other tax proposals, and I'll just list through these and I could answer during the question period any details. And of course, anyone is welcome to contact our staff rather, and we can provide details about any of these. I feel kind of bad bringing up issues and then not explaining them, but this is what the legislature is looking at. So we're counting at least 9 new taxes and sources of revenue that lawmakers are thinking of imposing. One is an expansion of the family leave program. So that would be a higher payroll tax. They would repeal the exemption for small businesses with 50 or fewer employees. And so the family leave mandate and payroll tax would apply to every business in the state, even if it only had 1 employee. Also, the Mike Kreidler, the Health Insurance Commissioner, is proposing a $3.25 per person health insurance premium tax. That's on top of the taxes that we have now in insurance. There's a bill to expand the Seattle high earners jobs tax that was enacted in Seattle a year or two ago to the entire state. In the same way, we've all heard about the Seattle soda tax. That would be expanded to the entire state under a particular bill that's being considered. They're looking at a new tax on wireless devices. I testified on a bill to increase the death tax rate to 40%. So that's on family estates and businesses that are passed on to the next generation. The governor is very ardent about carbon taxes and a low carbon fuel standard that he calls it. Todd on our staff has been doing a lot of work about how that would increase the cost of energy and affect our economy. And then separately from that is an 18-cent gas tax increase that's being proposed as well. Gas taxes in our state are already about 63 cents per gallon, state and federal combined. The carbon tax plus the new 18-cent gas tax, when you add all that up together cumulatively, would bring taxes to Washington state to more than $1 per gallon. So we're going to see how that goes. And then lastly, the governor just signed a bill, one of the first pieces of legislation to be enacted, that gives modest unemployment insurance tax relief to employers all across the state. We see that as a good thing. But the problem is the bill also includes kind of a clawback in the future, which is to say the rate ticks up in future years in order to refund the unemployment system in Washington state to get the funding up where it needs to be. We do not see the kind of safeguards that the unemployment insurance system needs, since about $350 million was stolen out of our fund by overseas scammers and through online cons. Our view is that the state should allow employers to buy private unemployment insurance that meets a state standard. But if you had a diversified and competitive private market, it would be much more secure. There wouldn't be just one target for criminals to attack. And also it would give employers more choices about where to purchase that coverage. So let me wrap up there and leave time for questions, and I'll send it back to you, Dave.
Great, thanks, Paul. As you can see on your screens, this is the Q&A portion of the program. So last chance, if you have questions, start putting them in now to the Q&A box at the bottom of your screen. And that way we can get to as many questions as possible before the end of the event. Again, a thank you to Wells Fargo for sponsoring the event and our co-sponsors, Puget Sound Energy, Western Refinery Services, and VSH, the Certified Public Accountants. We thank you. First question up is for Tim. Tim, where do you see mortgage rates going over the course of the next couple of years?
Well, mortgage rates have a tendency to follow the yield on the 10-year Treasury. And, candidly, we did not anticipate the run up in rates that we've already seen so far this year. And so when you kind of look at what's happening, the investors are kind of waking up to the reality of the fact that the global economy is kind of reopening. And this is perhaps most pronounced in commodities markets. Copper and other metals are up in double-digit percentage terms already in the first couple of months of the year. But you also see it in things like, so when the pandemic first hit, we think about oil prices. Oil prices, remember, back in April went negative, like negative $38 a barrel or something. Oil's back up above $60 a barrel now. The worst fears about the pandemic weren't fully realized. It was pretty awful there for a while. But now with vaccines in hand and a lot of fiscal policy, not just in the United States, but around the world, the global economy is coming back online. So rates are going higher on the 10-year Treasury, and the mortgage market, which takes its cues off of that, is rising as well. We had back in December, we had 1.5% is our year-end forecast for the 10-year Treasury. We've already kind of touched that intraday at various points already this year. So it's been a more robust rebound in rates than I think most people were expecting already. Just as a lot of the economic indicators have kind of exceeded expectations along the way here. So, you know, if you're mulling a decision about whether or not to move, I think I'd say, you know, rates are still historically low at the moment, and you know, if you know you've got a refinancing opportunity or buying opportunity over the course of this year, I don't think there's a strong case for putting it off any longer. I think, you know, if you told me I had to make a bet as to whether rates would be higher or lower at the end of the year, I think they'd be higher.
Quick follow-up for you. You mentioned excess savings and the pent-up demand possibilities coming from excess savings. Have you accounted for, or how do you account for the lingering or the possibility of lingering uncertainty, kind of the emotional aspect of the market and the uncertainty people feel?
Sure. You know, that's a real big one, right? And you know, the lingering uncertainty is actually a causal factor in the saving rate, right? I mean, the fact that the households haven't spent as much is because some people are still kind of wringing their hands and thinking, my gosh, I don't know what, I'm not feeling super confident about my job prospects right now. I don't really know about, you know, whether or not it's safe to go fully back out. I mean, can we really plan a vacation for this year or not? So, you know, I think there is scope for that saving dynamic to be even stronger to the extent that these worries persist. What's more vulnerable in my forecast to rising uncertainty is, will the spending actually materialize? You know, just because people have saved up money, it doesn't mean that they necessarily will spend it. In fact, the the permanent income hypothesis is an economic, you know, it's a hypothesis, it's not a law, that says that if you get this windfall, if you get a short-term burst in some kind of cash, you have a tendency to not, you know, base long-term spending patterns, or in some cases even short-term spending patterns, on the benefit of that windfall. But you know, if the January retail sales report is any indication of that, the permanent income hypothesis is wrong. We had a more than 5% month-over-month increase in retail sales, and every single category was positive. If you look back at, you know, monthly figures for retail sales, you know, there's only a couple of months every 5 years or so in which every single category is up at the same time, and yet that's what we had here to start the year. So people are worried, but you know, they're also out there spending.
Next question is open for everyone. Can anyone expand on the heightened risk of downturn for construction in Washington?
I'm not an expert on construction by any means, but what I saw when I was researching for the presentation is that residential will still stay at pretty much the same level, so not going down, but not a big increase either. But commercial real estate, as you can imagine, does show a drop, you know, as people, I think, are reconsidering how much office space they need based on their employees, you know, some working from home or having some rotation of remote working. So the information I've seen, not Whatcom County specific, but in general for the state and the Seattle area, is that construction employment and construction total volume is going to pretty much stay flat in 2021 and 2022, but then drop in 2023. But if you dive into those numbers a little bit more, residential is where you're seeing kind of the increase, but commercial is where we're definitely going to see a slight decline in construction.
Next question is directed at Paul. Paul, what's the total impact of state income if all 9 income tax or other taxes that you mentioned are enacted?
Yeah, so if the impact on the population is significant. The impact for the state is great, of course, because that's the reason they enact the taxes, is because they want more revenue down in Olympia. But regarding the entire state, it affects it. It will be a drop in household income across the board, especially for taxes like the gas tax. Many of these are regressive, the soda tax, vehicle fee taxes. We have not added all those up to measure the cumulative effect. We know that it will have an effect, but the most disappointing thing is that lawmakers haven't added it up either. They don't even think about that. They see each of these proposals as a discrete revenue raiser. They get an estimate from the Office of Financial Management of how much money the state will get, and then they go ahead and add to the tax burden. According to the Tax Foundation, we have one of the latest tax freedom days of any state. It's in mid-May every year. What that means is the average Washingtonian, after they've paid all their federal, state, local taxes and can begin earning money for themselves, is around May 15th. So that shows what the total tax burden is. But the most disappointing thing from our point of view is there's not much discussion at the state capitol about the morality of lawmakers continuing to add to the financial burden on the average family in our state, even though, as I mentioned earlier, the government has healthy revenue and doesn't really need the money. So this is driven by ambitions to expand entitlements and create new programs, rather than lawmakers stepping back and adding up the cumulative burden that's falling on everyone.
Thanks, Paul. Tim, this is a follow-up to, there's been, including at Washington Policy Center, some writing about how U-Haul trucks, for example, are pouring out of the state, not coming into the state. Do you see any major regional trends that would indicate maybe a shift in how states are dealing with the downturn and changing the competitive nature of some of these states?
Right. So when you kind of, there are a couple of different things that we can look at to answer that question. There are some people on our team that focus specifically on these regional dynamics, and there's data that you can mine from LinkedIn, which is, the zip codes that people have identified with at this time last year, and the ones they identify with now. And what you generally see is transitions to where if we can genuinely work from wherever we need to during this period, people are, by and large, moving to warmer, more desirable, sometimes less expensive sorts of markets. So going off memory, some of the cities that saw some of the biggest net in-migration from that was Austin, Texas. I think in the top 10, there were 4 different cities in Texas, a couple in North Carolina, Charlotte and Raleigh. And some of the outflows were in places where you've seen it before the pandemic, like Chicago, which is, Illinois has kind of led the country in net out migration the last few years, but also Pittsburgh and Cleveland and other markets that have seen a little bit of their population flowing out. Fortunately for Washington, there's still plenty of people moving in, and it doesn't have the same. You think about the deductibility of state and local taxes and how that's negatively impacted places like California. That's not been as much of a headwind for the state of Washington.
Real quickly, I'm going to try and hit on one more question. I want to remind people it is 9 o'clock exactly. So if you need to go, we want to respect your time. I want to remind you that the entire video presentation will be available on the website, whatcombusinessalliance.com. You'll be able to see that there. And there's been a number of people asking for slides to see your slide presentations. If you can make those available, Dan and Tim, we'd like to be able to share those if that's possible. So we'll have those links up on the website if it is, and if not, the whole video is there. So that's good as well. Can you touch on the impacts to the local economy? Can anybody from Western Washington University not having the majority of students in Bellingham this year?
I haven't seen specific data on that, but I mean, I can state the obvious that, restaurants, bars, hotels for parents visiting students, that's all contributing, I'm sure, to the economic downturn and the unemployment rate in Whatcom County that I mentioned during my presentation. But I don't have any specific information on Western not being open, what that means to the local economy. But like I said, it's somewhat obvious. Maybe the Whatcom Business Alliance does, has information on that, or maybe Western does, but I haven't seen any specific information on it.
The next question is directed toward Paul. What's the probability of, I'm sorry, it sounded like I interrupted somebody. Was somebody going to add?
I was just gonna add to what Dan is saying, is that, in a strange way, the universities almost fall under the hospitality sector because they run dormitories for tens of thousands of students, and mostly those dormitories are empty. And so in all communities across the state that host a college or a university, that's led to a drop in the local economy because that normal spending just isn't there.
Quick question for you, Paul, directed at you. What's the probability of Senate Bill 1596 being enacted?
The capital gains tax, income tax, the probability is pretty high this time. We have been doing a detailed count in the House and the Senate, and of course with the governor. The governor proposed the tax, so we know that he'll sign it if it gets to his desk. The same capital gains income tax has passed the House of Representatives in the past, so we know the Democrats have the votes there to pass it. The sticking point has always been the Senate Ways and Means Committee and then the full Senate. So as I mentioned earlier, it did pass the Senate Ways and Means Committee just barely. It was brought up very quickly and then passed within about 24 hours. Next step is going to the full Senate. There are 3 senators who on the Democrat, I'll back up. All the Republicans are going to vote against it. So that's 21 votes against it immediately. Senator Sheldon, who often votes with the Republicans, as I mentioned, will probably also vote against it. And what that leaves is 3 votes remaining to defeat the bill. If those 3 votes come from the Democrat side, and again, there are some more moderate senators who are hesitant about voting for this tax, and that's where the tipping point lies as to whether the Republicans and the 1 Democrat can pick up 3 more of their colleagues to defeat the bill. And the reason I'm walking through that is just to show how razor thin the vote count is in the state Senate when this bill comes up.
Well, there's no doubt we could get into what the economic impact and financial impact for Washington State could be on that. However, we have reached the end of our time. I do want to thank Tim Quinlan of Wells Fargo Securities for being a panelist, Dan Meade Smith, president of Washington Policy Center, and Paul Guppy, vice president for research at Washington Policy Center. I want to thank each of you for participating. I want to thank our prime sponsor, Wells Fargo. I want to thank my infant daughter for not waking up earlier in the broadcast. The Puget Sound Energy for being a co-sponsor, Western Refinery Services for being a co-sponsor, and VSH Certified Public Accountants. I want to thank all of you. And again, make sure you go to WhatcomBusinessAlliance.com for the full video presentation that you'll be able to see. It takes a little while to upload those videos, but I'd expect it within 24 to 48 hours. Thanks again for participating. Thank you for watching. And please consider a membership with the Whatcom Business Alliance. Thank you.